All right. So first time doing this. Aaron, why don't you introduce yourself and then I'll do the same.
Great. Derek, what's going on, everyone? My name is Aaron Moore. I'm a licensed financial representative, financial advisor, financial educator based here in San Mateo, California. Our firm is Sagecrest Wealth Management, based here in beautiful San Mateo. And LPL, we share a broker dealer between us, Derek. And I'm really excited to be here. Thank you so much for having me.
Yeah, it's great. Yeah, good to be with you. Derek DiManno, founding financial advisor, Flagship Asset Services here in Towson, Maryland, just north of Baltimore, and excited to talk about some financial concepts. So, Aaron, what I was thinking, maybe we'll just like get the brain moving, a little warm up. Why don't we talk about the basics of traditional and Roth IRA, and then talk about something that's a little bit more interesting, maybe Roth conversions, and then this thing that they're calling mega backdoor Roth for our people. You want to maybe just give us a little on traditional IRAs?
Yeah, that's fantastic. Well, first of all, Derek, I think we got however much time we have booked today. I don't think we have enough to really go into all the things that people want to know about Roth, because there's, like you said, you got Roth IRA, Roth conversions, Roth contributions to your 401k, a lot of different ways to get money.
Yeah,
let's start you mentioned the traditional IRA. So let's just compare these two, because a lot of people hear these terms. Well, what do they mean? The traditional IRA, and then there's the Roth IRA. Well, what are the difference? I want to give a farming analogy. Here we are in California. I know you got farmers over there. When you put a traditional IRA, you are taxing the harvest, right? You put your investments in, you're able to take a tax deduction the year that you make the contribution. But then that grows year over year. You're able to pull that money out when you're 59 and a half. Hopefully you wait till longer, but that's the first time you can get to it without, other details that I won't get to. You pay all the taxes on the gain on the backside, right? So you paying a tax on the harvest. For the Roth IRA, you're putting after-tax money. You're taking no tax deduction in the year that you make the contribution. But what you do get is over the lifetime of the investment, all of the growth on that investment is tax-free when you pull it out, assuming a few things. Again, you have to be 59 and a half. You have to have had the Roth open for 5 years, which is pretty easy to do if you're starting early. And all of the contribution, that's the basis, plus all the growth, that comes out income tax-free. And there's some really great things about that we may or may not be able to get to, right? Because just final thing I'll say, Derek, and then I'll give you the conch back.
Sure.
What we're looking at when we're doing financial planning for our clients is not how much tax you're paying in any one calendar year. We're looking to minimize the taxes that you pay out over your entire lifetime. So the Roth is a great way to do that. Traditional is a great way too if you have a lot of income in the current year and you're looking to drop into those lower tax brackets. But again, depending on your situation. Was that helpful, Derek?
Yeah, I think that's great. And Aaron, what I love about what you were just sharing is that, you have the basics of traditional and the basics of Roth, which largely carry over to retirement plans, right? But there's no one size fits all. And I think that you didn't say it, but it was embedded in the things you were saying, is that, there's some nuances and there's rules and there's limits, and they're all really important. And trying to figure out where one of these fits maybe better than the other, or how it fits, really is the financial planning process, right? It's that whole thing. So I think that's great. So if we kind of veer towards this conversation on Roth, saying that we have like a basic understanding maybe of the two at this point. When you talk about Roth, we have the Roth IRA that we contribute to, right? We have the Roth IRA that we've potentially rolled dollars out of a retirement plan into. And then we have this thing that is a Roth conversion, right? And so, I think it's important when we talk about, let's say, contributory Roth, a plan that we've contributed to, as you were describing, and then conversion, how they're different, like at like a mechanical level. And so I think, in my mind, it's really pretty simple. It's like how the money gets in there, but you want to just share that mechanically, that difference.
Sure. Well, we'll start with the Roth IRA. So given that we have, I think, 10 more days to file taxes if you've made an extension, well, last year's numbers, if to make a contribution, which is new money, right? You're putting new money into a Roth IRA. In order to do that, if you're single, you can't have more than $138,000 of adjusted gross income. If you're married, filed jointly, you can't make more than $218,000. So for some people, that's great, awesome, easy. I can make that Roth contribution. But for a lot of people in the Bay Area, could be true on the East Coast as well, you easily get over those numbers. So it's almost impossible to get money into a Roth IRA. But that's one way and kind of the most basic way to get money into it. Early in my career, I opened a Roth, and because my income was so low, I was able to put money directly in there. The other way we're talking about contributions still, and this is new money going into a Roth, is through an employer plan. And a lot of companies, especially here in the Bay Area, are getting really hip to this. They're making Roth 401k an option. So that way it erases any need to worry about how much income you make. There's no income requirement. So you can make the full $22,500 contribution this year after tax into Roth. And then Derek, I'm going to leave the mega backdoor to you. So listeners, sit tight because Derek is going to talk about that. But that's putting new money in. Okay. So that's how you get new money in. You take it from your current earnings. You have to have earned income. That money can go into the Roth IRA or into the Roth 401k, as I was describing. Real quick, let's talk about conversions.
Yeah.
So you have a traditional IRA, or you have a 401k that you're rolling over into a traditional IRA. Any point in time, there's no limitations in terms of how much and when and how many times you can do a conversion. And so the mechanics of that is moving either money, dollar, or securities from your traditional IRA account. And how we do it at LPL, it's called a journal. It's really easy. We journal it from the traditional IRA over to the Roth IRA, right? So it goes from this account, over to this account. And now you've got it in the Roth. Whatever dollar amount or the value of the securities that you convert, that gets added to your income tax in the year that you make the conversion, right? So if I do it now, we're here, October 2023, I'm going to pay income tax on the conversion amount when I'm doing taxes come April 2024. Okay. So that's what a conversion is. That's 101. There's some really exciting stuff that we may have time to get to today in terms of how strategically to use conversions, but just in terms of the basics, 101, that's what it is. So contributions, new money, conversions, that's money that's already in a pre-tax account that you want to convert over to a Roth.
Yeah. So Aaron, I think that's great what you just shared. And I love what you said about, like there's all this exciting stuff you can get into. And I think like here, one of the things is figuring out the concept sounds so appealing, right? The idea of Roth and paying no tax on the harvest sounds so appealing. And I think when we see that, in articles online and in different financial publications, there's like a headline appeal to it. One of the things that we believe is really important here is that we go through like a checklist, a flow chart to figure out, okay, given your specific fact set and knowing that the end state is appealing, is the journey worth taking? Right. And for some clients, the answer is yes, and we're willing to take it, or yes, and we're not willing to make the trip, or maybe not. And so I know you didn't say that specifically, but I think it was embedded into your description of kind of like the nuances here. And so really important, like, I'm not telling you, I'm telling everybody that maybe is listening to us, is that like, when they sit down with Aaron or Derek, the idea is like not to go from start to finish. It's to figure out how do we best map that route, and do we want to go on the journey, right?
Derek, can I interrupt you? Can I interrupt you real quick?
Yeah.
I think it's so important what you just said. Going on the journey with us means that you hire a financial advisor that you know and trust. And then the second most important part of that is that the client accepts and takes the advice that you're giving. Because I think that one of the hardest things to do for a conversion is to pay tax now. It's easy when you have to, right? It's kind of like when you wait until the night before the deadline, you have to do it. That's what I call, paying taxes later, right? We're waiting till the final deadline. You have to, because you have to take a required minimum distribution, which is, we're not going to talk about that, but in terms of taxes, that's why it could be so beneficial to do these Roths. But in the year that you do them, it's kind of like telling yourself early, you're going to eat healthy and exercise. Well, you're going to reap those benefits much later down the road, but maybe today you want that cheeseburger and fries, right?
Yeah.
Okay, so I don't want to interrupt, but I just wanted to say
No,
that's
I think
one of the most things.
No, I
Yes.
think that's great. Ultimately, I think what you're sharing or revealing to anyone that is willing to listen and listening currently is that the idea of the planning process is to not go on a gut feeling, but the words I would use here is to create like transparency and visibility, clarity around the decision that we're getting ready to make to the best of our ability, right? Fully knowing that we could have what we believe is a really good view of the different variables and of the decision, make what we believe is the right decision and not always get the exact outcome we wanted. But the idea is to not go off of like a guess, like this is a hunch, and so we're going to make a long-term strategy built around something that we read and it just sounds really cool, right? Maybe you buy sneakers like that, but you don't do Roth conversions like that.
Well, I do actually want to push back because watch this. I have a gut feeling that we're going to have higher taxes in the future.
Oh, yeah. Okay.
I have a gut feeling that 2017 taxes were reduced. The estate tax exemption was increased.
Yeah.
If Congress does nothing, we're going back to 2017 numbers, which means that the highest tax brackets are going to jump by 2% each.
Mm-hmm.
So you're going to pay 2% more in tax on top of all the other tax we pay if Congress does nothing. I have a gut feeling that that's going to happen. I have a gut feeling that you look at the underfunding of Social Security, I look at the trillions of dollars in debt that this country has.
Yeah.
I'm looking at higher taxes in the future. I'd call that a gut feeling. But in terms of your point, absolutely, you need a strategy. You need to have it written down. You need to know exactly what you're converting, why you're converting, what the tax bill is going to be, how that's going to impact your plan long term, and then you can use your gut.
Yeah. So Aaron, this is really fun, this conversation we're having about this. So, Winston Churchill was quoted to say, you can always count on the Americans to do the right thing at just the last moment. Right. And so I feel with Social Security, yes, it's underfunded. We'll fix it when it has to be fixed. Right. It's one of those things. And so, what you were just sharing, I think is like, it's real fun. That what the conversation we're having is like fun. But what I love about it is you're kind of in jest saying I have a hunch, but what you're really talking about there are assumptions in the planning, right? And so like we're joking with each other here. One of the things for somebody that's like watching this, or somebody's flipped them and said, oh, this is my guy, or like whatever, is that there's certain assumptions we have to make in planning. And the assumptions on where our tax rates are going and our debt and how these things are going to be handled, are assumptions that we need to get up and down on with clients, right? And then figure out how they come in. And so I think that's really great. To bring that maybe back around to Roth and Roth conversions, like I just want to note from like a definition type sense, we have like a contributory Roth, and then we have a conversion, right? And then you have that one that's in the middle that's a transfer where you opened it somewhere else and now you moved it in. So, but they're all the same type of tax. And so you just went over how we get it in, right? And how we might get it in. And we just talked about all that stuff. One of the things that you alluded to and said that I would handle. So I'll talk about now, if it's okay with you, is this mega Roth that everybody talks about.
Mega Roth.
The mega Roth, right? And
The
mega
Meg,
Roth,
right?
yeah, mega Roth, and what the concept of making non-deductible IRA contributions and converting those are tied together, right? And so both of these are kind of like higher level concepts that we're not necessarily recommending here. We're just talking about, right? And really, you need a professional. You need, I would think you have a trusted advisor, and probably a CPA, and everybody's looking at this to make sure it's in your best interest. But what you're doing with a mega Roth is you're using your 401k plan or your qualified retirement plan, and you are already contributing to the limit. And then what you're taking advantage of is after-tax contributions into this plan, and then converting those into Roth money type inside your qualified plan. That's like, so let me just say that again. You're maxing out your retirement plan at work. Your plan then allows you to make up to what there's actually another like watermark that you can go up to for qualified plans. So then you're gaining access to that, and you're putting after-tax money there. And then the plan has a provision that allows you to convert it. So there's like several steps there, right? And I think the first really key step, in my opinion, and Aaron, like, I'm interested with your opinion, but the first part of this is, one, if all the other things fall into line, are you in the position to save this amount, and does it make sense in the planning, right? Given all the other nuances of your financial plan, right? And that's kind of, to me, where you start. And then it's okay. So yeah, we're looking for a way to save more, and these are retirement dollars we're looking to save. And based on what, our assumptions and all that stuff we kind of talked about a minute ago, let's explore our ability to do this thing called the mega Roth, right? And so now we're saying, okay, what do we need to do here? So first is we need to make sure the plan is set up to allow these after-tax contributions and can accept them. So there's like some testing. And so there's some things you need to talk with your human resource person on to get a plan description, and then maybe be in touch with somebody, what we would call in our industry a TPA, which is not like an acronym for toilet paper. It's a third-party administrator, and they do all like the accounting on your retirement plan and the testing. And so then we need to make sure that the plan can accept it. And if it can accept it, then it has the provision to convert it, right? And so chances are, if you find yourself in the position, if Aaron walks through all this stuff with you and finds that this would make sense, there's probably a pretty good chance you'll be able to do it, right? But it's not a one and done. Aaron, I don't know if you have any thoughts on that, insights, general gut feelings like we were talking about before.
Yep. Yeah. So this is something that we help we have, we're here in Silicon Valley, right? So we have a lot of folks that work at the large tech companies on the peninsula. And what happens is that the plans do have Roth, right? The companies have gotten smart, that they've updated their plan documents that you were alluding to with the TPA, updating the plan documents to allow for, first of all, Roth contributions, new legislation that potentially the employer's contribution is going to be Roth. Mm-hmm. So here's the challenging part that we've seen when clients come to us and say, hey, we want to work with you. Here's what we have going. We can save, right? To your point, we've gone through the planning process. We looked at our cash flow and understood that we're able to save this year. It's up to 66,000. Derek, if that's wrong, or Alex, you can cut that out later. 66,000 is what you can maximum put in, right? After tax, all the different ways. 22.5 is all you can do in that traditional 401k environment. But what we see where the mistakes happen is that people are electing to do the after-tax contributions. Mm-hmm. But then what's happening is that they're forgetting, actually. They're not, you can do it, but then they're forgetting to convert it and move it over to Roth, because you have to build it up into the after tax, and then you have to sweep it over to the Roth account.
Yeah, I
And
love
so
that.
that's something that, I mean, clients hire us to do that type of work. And so what winds up happening is, since we can't pull the trigger on that move, we schedule meetings on a regular basis with those clients that have that in place, so that we can do that thing together.
Yeah.
Because it can be complicated. And it can be really beneficial, though it could be timing. So that's kind of the cursory of, the things that we're looking out for in terms of if you can, and then how you approach.
Well, and I love what you said there at the end, Aaron. And I think sometimes we take it for granted that, we're documenting, and we're putting reminders on our calendars, and that some of this stuff is time sensitive, right? And that things do get forgotten. I mean, part of the value of working with a professional is that they're helping you remind you of these things, right, that need to get done in the planning, so that you don't call the game on the 1 yard line and just like turn off the lights, right? And so I think that's really great.
So for example, Derek, right? So talking about that, we're about to finish up the final time to lock away your 22 taxes. So let's talk about, if you were doing this mega backdoor Roth contribution in 2022. Here's an example of how you could get this incredibly wrong, okay? So at the beginning of the year, you decide that you want to do this contribution, so you max out all your contributions. At the beginning of 22, if we all remember, it was a very painful time in capital markets. We were all securities and bonds. Both, they're supposed to be non-correlated assets. Both stocks and bonds were down in 22. I think it was a 2-time in a 100-year event, right? Where both stocks and bonds dropped. You can blame interest rates, whatnot. Imagine this for our example. You make your contributions throughout 22 into the after-tax account. You buy the restaurant menu option that you have in your 401k. Yeah. Let's call it some S&P 500 type of investment. You don't do the administrative move where you're moving those assets from the after tax into the Roth. So then what happens? Market recovers towards the end of 22 into 2023. We still haven't done it for this example. Now you say, oh, shoot, I just heard this podcast from Derek and Aaron, and now I got to go do this thing. Well, guess what? Whatever dollars you put into that after tax have now grown by 30%. So whatever benefit you were hoping to get, at least short term, from those Roth contributions, you've now paid on, first of all, the principal that you put in. And then, of course, when you do the conversion, it's at a 30% premium. So just in terms of the challenges of the administrative part of that. Okay.
Yeah. Yeah. And Aaron, so that's a good point. I mean, at maybe a more simple level, like when you have non-deductible IRA contributions, so you're talking even smaller amounts, and you mentioned something like that investment piece, right? So when you're making these non-deductible contributions, as long as there's no growth, it was non-deductible. So when the conversion occurs, basically there's no tax, right? So that's like another tool. And we could maybe, if we have listeners that express interest, we could talk about that in a little bit more detail. In your example, you're saying, hey, but the money was invested and then forgotten about, right? Which I guess is, in this case, causes a challenge, because now we've captured, like, based on luck and timing, this rebound, and our non-deductible contribution has now grown, and so we have taxes to pay on money that, so all those things are just like, and we could probably go through endless examples of that, but like, there's just so many things to be thought about. And if I guess the point is if this is not your profession, probably makes sense to have somebody helping you on the path, right? Walking with you on this, like lighting the trail to help you make the decisions on these switchbacks. So cool. Maybe we shift gears, if you're cool, Roth, traditional Roth, conversion, mega, right? And if we have some interest, we can talk a little bit more about it. And I know you and I talked about something, but it seems like based on kind of the time we have set aside, maybe what we can hop to now is let's talk about this concept you and I chatted about before, like this buying versus renting. And I think it's interesting to do because we're on two different coasts. Maybe with clients that look similar, maybe that look different, but I think that with real estate being such a geographically nuanced thing, this is might be a little bit fun. So I know we had put buying versus renting, and so maybe you just give me like level set. You're in the Bay Area, right? You're in California. Tell me like at a base level, kind of the things that your clients need to consider when it comes to the place that they're living.
So it's a whole, sandwich of different levels of entry into the real estate market. Let's start at the kind of the bread level, the toast, which is, I'd say, the entry point. Can't have a sandwich. I guess you could have a lettuce wrap. Okay.
Yeah,
we're in California. A lot of people going lettuce wrap it in and out. All right. They're going, so protein style, that's what they call it.
Okay. All right.
So if you are a young professional living and working in the Bay Area, you could be making 250. If you're with a partner, you could be making almost $400,000 easy a year. All right. Anywhere else in the world, wow, you make $400,000. How do you not own a home and have a nice life, right? But here in the Bay Area, it's very challenging. A condo in my area is $1 million. Mm-hmm. So to have $1 million place, you're going to need to put down $200,000 at least for the down payment. And then if you want to do any type of upgrading, add $20,000 to $50,000 for carpet, paint, appliances, right? That kind of stuff.
Yeah.
So that's the reality. You need $250,000 of cash in order to put down. So that's the entry point. So that becomes a challenge, right? You have to pay property tax in California. And so that becomes an additional cost. So in terms of the entry point for real estate, does it make sense for a young person to rent and save, right? For later on down the road, especially now with interest rates, that's a huge consideration. Mm-hmm. Or does it make sense to buy because we're going to be here for a long time? We had a mortgage. I was lucky enough to buy in 2020. So we got a 3% interest rate. I have clients that have 2.25% interest rate on a 30-year fixed. It just doesn't seem fair, right? Because if you want to buy a place now, right, you not only have the high entry point for the home, but then you have the interest rate. So there's a lot of things against that. On the other side, the other piece of bread, the top piece of lettuce on that protein style, that's the retirees who are saying, my assets are tied up. By the way, Derek, this is another like 3-hour conversation too. Right?
Yeah, it's good. It's all good.
But I'll complete my example, and then we'll go from there.
We won't do all the fixings in the middle.
We're gonna do mozzarella and mortadella. Okay.
Yeah. All right. I'm with you. It's good.
The Italian, right? Yeah. There's some great places, Derek. I'm gonna take you when you come visit.
All right. Deal.
All right. Cool. So on the other side, we're talking about retirees, right? People that are approaching retirement. Maybe they already own, but all their assets are tied up in their home, right? So for the last 2 weeks, I've been teaching a retirement class in Los Altos, California, which is just right next door to Mountain View. You have homes that people have bought. In my class, they're telling me last night they bought the home for $400,000. It's now worth $4 million. They work at UPS or they're a teacher, right? So there's people like that, right? That are kind of just by accident gotten house rich in California. A lot of times for them, it's like, it makes sense to stay in the home because the property taxes are low, right? But then they have no cash flow. So for them, it's a question of, wow, I could sell. There's capital gains. I'm not going to talk about the rules there, or else that's another 30 minutes on my talking, and I want to get back to you. But I could sell and take those assets and fund my lifestyle and rent. And then renting allows me to not pay property tax, so I don't have to worry about where I go. I don't have to fix the roof, the water heater, the porch, the the pipe that busted in the wall that now you have to fix the ceiling, all these things, right? So in terms of that mindset, okay, so that's like kind of generationally, the young folks, does it make sense to rent or buy? Depending. Right now could be a time to save, right?
Yeah.
And then on the flip side, those retarees are coming into the question.
Yeah, let me ask you something about
Yep.
the younger side.
Sure.
And I know, I'm like, let's figure it out and not go on a gut, but I'm gonna ask you for like your gut on this. Like, do you feel like the general consensus with younger clients you may have, or just younger professionals that right, that are within arm's length of you, that the direction is to home ownership, or that they see renting as like a long-term viable option?
I would say it's split down the middle, Derek, and I think
Okay.
it has more to do with your approach and thoughts about the world and the future of how, right? Because remember, we're in San Francisco Bay, so everybody is like, what's the talk here is that what is Tesla going to do? We're going to get to the point where I'm going to park my Tesla or whatever, my car, in the parking lot, and then while I'm here doing this interview with you, I'm going to release it out. It's going to go drive around and earn some money for me. Right.
Right.
So it's kind of like I'm renting it. And then when I need it, it comes back to me. And same thing with homes. So people are on that path of, why would I own something when I can just have this collective thing and kind of have this freedom to move? But then our clients that are family oriented, that have kids, that are looking to, like, the traditional stuff. I'm looking for a safe neighborhood.
Yeah.
The schools need to be good.
Right.
And I don't want the instability of rent going up, or the owner deciding to sell and now I have to move, which
Yeah.
disrupts
Good
my
point.
entire life.
Yep.
And those people are also present and prevalent. So maybe if anything, it's not that it's one or the other, but it's become more polarized. And the people that feel that way have very specific reasons for wanting to be a homeowner, and very specific reasons to want to be a renter, to have that freedom and flexibility.
Yeah. Oh, well, that's great. Yeah, I love that. Thanks for sharing that. I think, Aaron, here, and I would say the majority of the times that we're having this conversation, it's a little bit different. So like, I won't rehash kind of the things that you're talking about, because I think those are all like real, no matter where you are from, what, West Coast, East Coast are in the middle. Interest rates are up. If you're in a transition period, like with geographically, with your home and your age or moving, like there's some considerations that need to be maybe looked at harder, that when interest rates are at 2.5 or 3%, maybe it was an easier decision because the math just wasn't as intimidating. I don't, if that's fair. One of the things, though, that quite commonly comes up in our planning with clients that are like transitioning to a work optional lifestyle, or in retirement and not working, the idea about like a vacation home or a second property, if they don't already own it, right? And so, like, with the idea that also now interest rates are higher, and we're talking about cash flow. And so one of the things is that we commonly will look at is not so much a buy versus rent, but like a buy versus travel, maybe I call it, right? So like extended Airbnb, like, do we just want to snowboard? Does it make sense to have a place in Florida for 6 weeks of the year that you don't have all those things, like, the condo fees, the concern about like the water pipe in the wall and all these things, and then you can go somewhere else the following year, like you have that flexibility. And does that make sense when we start to look at the numbers? So that's a conversation that we commonly have with clients about, okay, like we have a travel goal. We may also have like a second home goal. Like, what do these really look like? What is the real goal? What is the what is that ultimate experience? Are we saying we want to buy a vacation home really because we want to travel and, you know, or we want to be at the beach? And is that really the best way to get to the beach? Right. I mean, I think part of that is just asking maybe good questions
Yep.
For clients. And then we're fortunate to live in an extremely exciting time in history, Aaron. So we have the ability to, you know, be coming out of 100-year pandemic, experiencing things that are very similar but slightly different than the past. And we have these interest rates, and now we have interest rates and like a hard real estate market where most homes, you know, have gone up and they have stayed there. And, you know, depending on who you talk to, will probably stay there and maybe continue to go up. So, you know, yeah, you know, same story, different fact set, maybe, right?
Well, also, I mean, it's the same. I would say it's similar in terms of the mindset, right? So, so now we're getting deeper into the sandwich. I'm going all in, all right, on the metaphor,
Okay.
going all in. So now we're talking about more of like the meat and potatoes of the thing here. Clients who are blessed to either have inherited real estate or have the asset level to purchase second homes or third homes or fourth homes, whatever that is. It's similar, right? Because here in California, here's a great pitch for the Bay Area. I have Santa Cruz, Half Moon Bay Mavericks. That's 30 minutes away. Santa Cruz is an hour. That's the beach and the redwoods. And then I got Napa Valley, an hour north. So you got world-class wines. And then 2.5, 3 hours away is Lake Tahoe, for you got snowboarding and hiking and stuff. And then the whole range, the Sierra Nevadas. So up here, people that are who want to buy a second home, that's for kind of the snow. We don't have snowbirds here. It's just you go to Tahoe, right, in the snow,
Right.
and then come back to the Bay when you're done. They'll have family, right, that all have purchased around a small lake, right? For example, they have an HOA and they've got like a gated community. And so they're all like purchasing. I know people that do that. And if you go to Lake Tahoe regularly, you might buy one and then have it be Airbnb, because that's a great city to have Airbnb because people are always going there to stay. And then, right, so then you have like hardcore people that are doing that. And then others who are saying, well, yeah, right now. And by the way, I don't know. I mean, I just look at how expensive money is. If you could rent or buy, I'd rather rent now. That being said, Derek, clients with a lot of cash. So if you've got a lot of cash or assets that you're able to raise, this is a great time to buy, because what we didn't say about lower interest rates back in 2021 is that cash offers and then above asking price. So you have the problem of cheap money. Yeah. But then you'd have 30, 40 people bidding for one home.
Yeah.
So it's just that, you know, just
Sure.
stacking more icing on the cake. Now you don't have that as much. The demand isn't as great. Maybe the supply isn't as great either. But when you find something, maybe now could be a great time because you don't have the, you know, the over asking price problem that you did. So
yeah, that's it. Well, I mean, I think that's an interesting point. And of course we saw that here. I mean, I think when money was cheap, you know, and we need homes, right? The data supports like for the next decade, we like don't have enough homes and we need to build homes and all that stuff. You know, you did have this like 40 offers and you had, at least I know, I had people that I knew that were, you know, trying to secure a home, whether it be a first or second home. And, you know, it was a really challenging environment where you had these things occurring. So, I mean, I think we're, you know, we can be so short with our memories, right? That wasn't very long ago that all that was happening. Hey, Aaron, we have probably enough time to talk about one more thing.
Okay.
And if you're game for it, I thought we might just like tiptoe into the waiting pool that is tax loss harvesting. I was hoping that maybe I could explain the concept a little bit here, and then maybe you could talk about how it works with your clients, like the way that it's incorporated into the planning. And then if there's something to add or something that we do different or the same, I'll jump back in if that sounds good to kind of bring us full circle here.
Awesome. Yeah,
Okay.
let's dive in, Derek. Let's
All right.
go.
So tax loss harvesting, I think, is something that most individuals, clients, like, and this is a generalization for sure, have somewhat of a limited understanding of. And the limited understanding I'm going to say is basically you have gains and losses that you offset, and then you take a $3,000 deduction against your ordinary income tax if there's anything left over. I would say that's like the vanilla answer that most people that have had investments, have had a conversation with an accountant about gains and losses, give when you start talking about it. Like, you agree, general sense, Aaron, that's, you think I'm kind of on track with that?
Yes.
Yeah. Okay. So the way that they really do work is, in a given tax year, you have short-term and long-term gains and losses, right? And so to the extent that you have short-term gains, you can use your short-term losses to figure out how much is positive or negative there, right? And then you do the same thing for long-term gains and long-term losses. And then if there's any left over, let's say we have short-term gains, we have leftover long-term losses, and we've already netted them, then we can bring them together and see if we can get them to zero or even a negative. Okay, so then let's say we net them, and now we have a negative. And let's say that negative is $10,000. Here's where it starts to get interesting. So now the client gets a deduction, $3,000 off of their ordinary income tax. But if you're doing the math with me, we had 10,000 in losses, 3,000 that we just used up. We got $7,000 left over. And for most clients, they think that the only benefit is that 3,000. The real power, I think, to doing active tax planning inside your greater financial planning is that 7,000 can be carried over to the next year to be used, or really indefinitely to when it gets used. And that's the power, in my opinion, of the planning, acknowledging that we can help clients understand that first, help clients look for that. And I know, Aaron, I'll leave kind of how that gets created and so forth to you. But then also work as a team with their tax professional that's looking that in my opinion is put in a position where the nature of filing taxes creates a sprint for most people, is the timing of it. So they're looking at 12 months to maybe 18 months if we have some estimated taxes. They're generally not looking at decades, because it's not the standard by which their work is judged, right? It's not really what they're employed to do. So that's a long runway to which I've given you, Aaron, to say whatever it is you want to say. So
yeah,
with
no,
that,
that's great.
Give me the lowdown on tax loss harvesting, the way you do it with clients, the things you see or don't see or whatever.
Nice. Derek, I see the Lady Liberty. You're handing it over from Ellis Island to Angel Island.
Yeah, there you go.
Handing the torch over to me. And kind of with that, I would just say that really, if we're looking at deducting losses every year, right? Okay, great. We're always looking to, if I could reduce my taxes. So that's a strategy, and that's powerful. And I want to connect just what we were talking about with Roth, with tax loss harvesting, because it's also a tax strategy. But the difference is that with Roth, as soon as you get that money, you pay the tax, your hands are clean, that grows, you have that benefit forever. You could have that same thing as you were describing, where you have this $3,000 loss, that's the maximum you can deduct on capital losses in every year. You could run that out indefinitely, but you're only taking down 3,000. That number might increase through the years, right? What we're able to deduct on losses. But the strategy is a little different, right? Because Roth, you get the money in there, you're good. With taxes, and this gets to your point about looking either very myopic, like right here, this calendar year, or we're looking at over a 30, 40-year period of time. Because where I'm sitting, I'm looking at a 50-year, 40-year stretch of what I'm going to be paying taxes. And so in terms of tax loss harvesting, that's how we manage your tax liability through time. Okay. So we start there. Capital gains is a unique tax. It's different than income tax, right? Capital gains rates.
Good point.
And interestingly enough, Derek, because I was talking about this last night in my retirement workshop, California taxes income tax and capital gains at the same rate, income tax rate, just as an aside. So there's no real advantage in California, at least on the federal level, 100 million%. So you have the capital gains tax rate. So let's talk bucket strategy real quick, because typically when we're talking about Roth things, these are all qualified accounts. These are all IRS labeled qualified monies. Okay, there's all rules associated with how you can put money in, when you can take money out, and how they're taxed. Well, on this taxable account side, what kind of stuff goes in there? Stocks, bonds, maybe some real estate interest goes into a brokerage account, taxable investment account. Also, for everyone that works at a publicly traded company, you're being compensated with RSUs, restricted stock units. Those are also taxable. So what we're doing every year is managing and looking at how much you're paying tax in all of these accounts, because you never get away from paying capital gains when there's a gain in these accounts. So how do we approach it? If there's an investment account that we're managing, we're looking throughout the year to systematically buy in and out of securities in order to capture that loss, and looking for a tax alpha of maybe 1%, right? Because you're able to deduct the loss. For our clients with RSUs that work at publicly traded companies, we're not part of the discussion, but just in terms of strategy, because concentration risk, same thing with taxes. You don't want to concentrate all your taxes in your traditional IRA. You don't want to concentrate all of your net worth into one stock, the company you work with, right? You get their 401k through there, your benefits are there, and all of your RSUs are there. So we're looking at diversifying that and managing that. So when we're reducing your position in the RSUs, we do that systematically throughout the year. That's an opportunity to do this tax loss harvesting, right? So if you work at a company that you have old shares from a couple of years ago, those could be at a serious gain. But if you have shares that were awarded to you 6 months ago or last year, those could be down. And that way you could realize some losses in those positions and make sure that you're not paying taxes in future years. So that's kind of a high level, but in terms of how we're looking at tax loss harvesting, it's really about managing the taxes you pay over a lifetime. All right, Derek?
Yeah, I like that, Aaron. And one of the things that I think gets overlooked sometimes in the planning is, so we look to investing and we look to tax deferral in these retirement accounts because of compounding, right? And then when we look at these after-tax accounts where we have potentially taxes that put a drag on the compounding, we still have the like that wonder of the world, as Benjamin Franklin would say, we have compounding interest. What I think sometimes gets overlooked is compounding interest takes time. Harvesting losses that get banked provide a benefit for down the road, right? So you use the analogy of like health earlier when we were talking, right? So taking good care of yourself now may provide a better lifestyle today, but down the road, staying in shape when you start to age and have health problems may put you in better position to deal with them. Tax loss harvesting, in my mind, is a lot like that, is that if we can pick up these losses and we even if we can't use them, we can bank them. For someone that has money that's outside of their retirement plans, right? Or owns a business where there's a potential liquidity event, or holds real estate as an investment, any place where we would have these capital gains, banking these with the idea that they're not all getting used, they're growing, compounding in a sense that we're saving them over time, becomes a real financial tool, like a lever that we can provide like the other financial professionals, like the accountant on the team, to maybe put our client in a better situation, right? So yeah, anyway, for what's that, whatever that's worth or not, that was, I think, a pretty good swipe at tax loss harvesting for sure. And I'd like to talk about, I know we don't have time today, but I'd love to talk a little bit more about executive compensation, like those structures, restricted stock options, like all these sort of like the alphabet soup that is the things that successful individuals inside these companies have, and maybe understand really well, or maybe at a basic level, or maybe not at all.
Yep.
That we could help with. So maybe we can
And-
put that on our list to start with next time, Aaron.
Yeah, I love that. And I also want to add that, because it was implied in what you just said, but just in terms of working with your accountant. So our best work, when we build our round table, right, of the executives at the table, when we help our clients, it's the CPA or tax professional, it's the estate planning attorney, right, the financial advisor, the CEO at the table, the client. That's how I like to refer it, because we can always get vetoed, right, Derek?
Yeah,
Our clients can veto our recommendations because not every decision is financial, right? There's a lot of non-financial decisions,
right.
that we were talking about even today. But, having these great relationships, and that is how, even more important for people the higher up on the chain that you go, because the options that you have available to you grow exponentially. So with that, Derek, it has been a pleasure chatting with you today. Thanks so much for having me on.
Yeah. Aaron, this has been great. Yeah, and I look forward to doing it again real soon.